Good afternoon. Market news now. Shares in Asia were lower with Chinese tech stocks in Hong Kong seeing big losses. Hong Kong listed shares of Tencent dropped 2.9%, while Alibaba fell 2.9%. As we look at what's happening in Europe, markets on that particular front slightly lower as investors digested corporate earnings, fresh economic data and a budget update from the UK finance minister. As we look at what's going on the US stock future side of things, little unchanged during pre-market trading after the Dow and S&P closed at record highs as earnings continue, especially when we look at Q3 earnings. But to look at the overall global market sentiment and how that's affecting some of our local counters, we are joined by Chantal Marx, who's the head of research at F&B Wealth and Investment. Chantal, thank you so much for your time. I mean, given what's happening globally, there were inflation concerns and various other things peaking out, especially stuff coming out of China-US tensions. Also, what is the global sentiment right now?
So global sentiment is quite negative today after we've had a few days of really positive kind of feelings around the markets, particularly in light of a very strong US earnings season and also some very strong sales updates coming through from European companies pertaining to the third quarter. What seems to have happened now is that markets are firstly concerned that, oh my goodness, are these earnings not peaking? They're so good. They might start coming off pretty soon. And then the other issue, as you mentioned, US-China tensions, never good from a certainty perspective. Markets don't like uncertainty, and that filtering through into what we are seeing right now.
On that note then, how's our JSE looking?
So the JSE opened sharply lower in line with what we were expecting, particularly what was flowing through from Asian markets this morning. It recovered somewhat to actually touch flat around about 10:30 a.m. But since then, it's trended downwards again. It seems as if the weakness is really across the board. Probably the weakest sector today, the resources sector. Obviously, that very much influenced by China. We are seeing the mid caps trading slightly up. So it does show you that the negativity on the market seems to be more a function of global markets and less a function of SA Inc., as we like to call it.
So early this morning on Sense, we had Famous Brands release their financials, group revenue up 50% to 3 billion yen year on year to August, but 22% down from before COVID-19. What did you make of the financials?
So to put that into context, I think it's very important to look at an unaffected or COVID unaffected period. And the last COVID unaffected period we have that also didn't include that terrible investment that they made in the UK would have been the second half of their 2020 financial year. So that would have been from September all the way to the end of February last year before COVID-19 hit us. And then they recorded revenue of 2.6 billion rand. So it does seem as if revenue at least is moving in the right direction. The problem that we're still having with Famous Brands at the moment is that margins are still under pressure, which means that from a profitability perspective, they're still lagging behind COVID-19 times. Now, there are a variety of reasons for that, but I think that the biggest issue that they are facing at the moment is that you still don't have that footfall coming into the restaurants. You don't have demand for new restaurant openings coming through, and you still have a recovery in manufacturing and logistics taking place. So still a lot needs to happen here. And of course, Famous Brands still have a chunky amount of debt on their balance sheet from their disastrous acquisition into the UK a few years ago. And they seem to be chipping away at it, but it's going very slowly.
Right. So yesterday we had a trading update from Tiger Brands, and they mentioned that basically headline earnings per share from continuing operations are expected to fall between 5 and 15%. I'm curious, how do you feel about Tiger Brands? Were you ever hot on this one?
I've never been hot on Tiger Brands. I think that their portfolio is just way too large for them to be able to steer the ship efficiently and effectively. Things have improved in recent years because they've kind of exited some of these loss-making operations that they had in the rest of Africa. They have been trying to simplify things a little bit, but they seem to be kind of facing a new stumbling block every year. The latest being the product recall that they suffered, along with the unrest in KZN and parts of Gauteng in July, which would have impacted everyone, right? But the product recall really hurt them, and the impact was larger than expected. And I think that's one of the reasons why I'm still kind of cold on Tiger Brands. I think the investment case looks better, but it just seems as if there's something new every single year.
Yeah. I want to go back to what you said about earnings, because we've been talking about supply issues for quite some time now. And I'm curious whether you're seeing those issues come through when you look at U.S. third quarter earnings, or is it something that we might start seeing in the fourth quarter earnings?
So a lot of companies are talking about it as being a constraint. It hasn't really filtered through in terms of companies performing poorly relative to expectations. In terms of guidance, we have seen a few companies come out saying, listen, we are struggling with component shortages. Sales are probably going to be hampered by the fact that we don't have all the inputs that we require to manufacture what we need to manufacture or sell what we need to sell. Notably, Apple downwardly revised the number of handsets it will be able to sell. I know I'm personally on an Apple waiting list for an iPhone 13. And it's definitely coming through. That impact will probably be more pronounced in the fourth quarter. But then in certain areas, guys are saying, well, this is an issue. We are handling it, and we still expect an improvement relative to 2020. And that came through from General Electric in its results yesterday. So it very much is a function of the specific company, the industry that they're operating in, and how they're able to pull those inventory levers in order to effectively manage these bottlenecks.
All right, Chantal, thank you so much for your time. That is Chantal Marks, who's the head of research at F&B Wealth and Investment. Tomorrow, we are expecting earnings from Amazon and Apple, so we'll definitely give you an update in terms of how those companies performed on Friday when we analyze those figures post-U.S. closing bell. We're going to take a quick break. When we come back,